Hi, welcome to Sensei Kujaku. I'm Krish Kothari. Today we're going to talk about India's largest private sector lubricants company, Castrol India.
先生クジャク
As always, nothing said in this video or any content posted on this channel is either a recommendation to or not to buy, sell or hold any security. Please do your own due diligence and consult a financial advisor before dealing in any security. Castrol was for long a darling of the stock market. Adjusted for various corporate actions, the stock price moved from 25 rupees a share in 2005 to about 270 rupees in 2014, compounding at 30% over this period. Since those heady days though, things on the stock price front haven't quite worked out. Over 8 years later, the stock price is materially lower at 120 rupees per share. So for every 100 rupees invested at the 2014 peak, you would have about 45 rupees today. What is interesting though is the remarkable consistency of business performance at Castrol India on many fronts over this period. Return on equity, for instance, has remained impressively high, averaging about 60% over the last decade. Free cash flow has also remained impressive, growing from about 500 crores in 2014 to about 800 crores in 2022. The question then is, why has the stock price sagged so dramatically, and what can we learn from studying Castrol India? Also, let's see if, admittedly with the benefit of hindsight, there was any sign of trouble over the years that could have served as a canary in the coal mine. If you haven't already, please subscribe and like our videos. I really do appreciate the support, and it's great to see our community growing. Before analyzing what has worked and what hasn't for Castrol, let's first understand the business. Starting in 1910, Castrol became a preeminent lubricants player in India, and along with the PSUs HPCL, BPCL and Indian Oil, dominates the lubricants market in India. The company has three divisions: automotive, industrial and marine and energy. Automotive is the largest and, as the name suggests, caters to two-wheelers, passenger vehicles, commercial vehicles and off-road vehicles. Castrol India has increasingly focused on synthetic and semi-synthetic lubricants as they are better suited to environmental regulations. The industrial division focuses on metalworking fluids and high-performance lubricants. Mining and manufacturing are key sectors for this division, the fortunes of which are largely tied to the general level of economic activity in the country. The final division, marine and energy, focuses on the needs of the shipping industry and the oil industry, primarily oil rigs. Castrol's primary cost is its raw materials, crude oil, base oils and additives. Base oils are essentially refined derivatives of crude oil. Packaging is also an important cost center, which cost is a function of polymer prices. As a result, the fortunes of the company are tied to certain key macro factors, primarily oil prices and rupee depreciation. Higher oil prices and a depreciating rupee are real challenges for the company, which is on a perennial cost-cutting treadmill to compensate therefore. Castrol seemed to have everything going for it, including high returns on capital, meaningful market share, and wide distribution. A closer look under the hood, though, reveals some concerning counter-trends. Conventional wisdom is that Castrol is a victim of the global shift from internal combustion engines to battery-powered vehicles. While that is no doubt a contributing factor in more recent times, the company has been facing challenges long before the shift gathered steam. For instance, in 2005, Castrol's total sales volume was 226 million litres. In 2011, this number fell to 208 million. 4 years later, in 2015, alarmingly declined further to just 191 million litres. So while the stock price went up tenfold, driven in large part by the PE expanding from 23 times to close to 60 times, underlying sales volumes were declining. I want to take a second though to cut buyers of Castrol stock through this period some slack and make a larger point on the difficulty of being a securities analyst. While the sales volume data is disconcerting, revenue doubled over this period, rising from about 1670 crores in 2005 to 3300 crores in 2015. Surely anyone looking at these data points cannot be criticized for concluding that the relevant takeaway is the tremendous pricing power and brand equity Castrol commands in a competitive market. Additionally, bulls would have interpreted these data points as Castrol focusing on higher margin products, and in fact, Castrol's operating margins rose from the low 20s to about 30% through this period. This is another example of how difficult business analysis can be and why intelligent people arrive at opposing conclusions on the same company, since conclusions are ultimately a function of which data points were emphasized in the analyst's mind. Coming back to Castrol, the key problem seemed to be growth. While the market was focused on the improving margins for some time, it eventually was forced to reckon with the single-digit growth, increasing competitive intensity, and challenging valuation. Remember, doubling revenue over a decade implies a roughly 7% compounded growth rate. The competitive intensity paints a bleaker picture still. Notice the steep decline in incumbent market share, as noted in Castrol's own annual reports from 2015 and 2016. In 2015, Castrol and the three major PSUs accounted for 55% of the market, which share had been maintained for multiple years. This number declined to 41% in 2016, indicative of growing competition. In fact, Castrol itself discussed the threat of OEMs themselves marketing lubricants. Stock prices are eventually slaves to earnings and business performance. In 2016, Castrol made 1,040 crores in pre-tax profit on close to 3,400 crores in revenue, with operating margins of 30%. In 2022, Castrol made almost 4,800 crores in top-line sales, but pre-tax profit was less than 1,100 crores, only marginally more than the corresponding figure from 2016. The key change was the margin profile, with the operating margin falling to 23%. Therefore, with the benefit of hindsight, we can see that even companies with impressive track records of business performance and operating metrics can be disappointing stocks to own. This is just another example of the pitfalls of extrapolation and paying too much. Undoubtedly, pointing these out is easier looking at the rearview mirror. So next time someone tells you to invest in a company just because a few metrics look promising and the stock has done well in recent times, remember to take into account some silent but all-important telltale signs. To the credit of Castrol India, management has continued to make attempts to increase market share and growth. The company continues to find avenues to market its products and deal with the cost pressures and competition. Time will tell just how successful these attempts are, and if Castrol India can make up for lost ground. I wish them luck. I hope you enjoyed the video and learned something valuable. Don't forget to like, subscribe, and hit the bell icon. Also, let me know in the comments what you thought of the video and if you found it interesting. Thanks for watching Sensei Kojaku.